Hey everybody, Al Abaroa, Financial Intelligence Training Wealth Instructor. It is Wednesday, it is July 11th, it is 2018, and I am back in the Chicago office. Beautiful, gorgeous day here. Awesome summer weather. Now, first, little congratulations to France yesterday on advancing into the World Cup final on Sunday. And today, in just about an hour from now, we have England and Croatia going to battle for that final spot. So we'll see who's going to be their opponent come Sunday. I hope you guys are paying attention to the World Cup. I know I sure am, and I know some of you out there are looking forward to Sunday's match. Now, what do we got going on in the world here? We got a lot of stuff today, right? We've got new tariffs. We've got Nato that's going on, right? We've got earnings season that's going underway. So the reality is there is no shortage of news. So we're going to address each of those topics rather briefly as to not make this an ultra lengthy post. So for starters, let's talk about something that I said on Friday's post, which was that earnings would begin 1 week from today, which is what I said last week, on Friday the 13th. Now, yes, Pepsi has already released. It's not yet Friday the 13th, but to me, earnings season really begins its kickoff with those financials reporting, and I've been getting a little ribbing over the course of this week based on the comment of that post. So I just want to clarify that, and those of you mocking me, you know who you are. You got your moment in the sun right there. All right, kidding aside, Friday we do have JP Morgan that's coming out to release. I think that's going to be an important note. It is expected that the overall earnings season is to show an increase of roughly 20% in earnings. Now, remember what I said, guys. It's not about the increase. It's about the reaction to the earnings, and that's really what we're going to be talking about and paying careful attention over the next few weeks. Now, speaking of reactions, yesterday after the close, we saw an immediate sell-off in futures after our president announced additional tariffs coming out to the tune of $200 billion. Now, those tariffs aren't going to go into effect until the reviews mid to late August is what that statement is. However, the reaction to that news was a minus 20 plus in the S&Ps. Now, we were plus 9. We closed down 23. We're still positive where we were day over day, or 2 days ago, I should say. So that is your reaction level. That's the number that you're going to want to pay careful attention to, in my opinion, and see where things really start to materialize. Okay, let's move over. Let's go to Nato for a second. So here, first day on his tour, President Trump stops in Belgium. Would have been a better visit had the outcome of yesterday's game been a little bit different, I suppose. Kidding, of course. Now, he is on a full-fledged attack about the strengthening relationship between Germany and Russia, and now their alleged dependence upon gas coming from Russia. Effectively, one analyst pointed out, they're saying that now this is a way of Trump not being able to control Russia, but being able to control Germany through the cash flow that goes out there. So it's a very strategic play, and we're going to see what type of conversation that creates when President Trump goes to meet Putin later on in the week. So that'll also be something careful to pay attention to. Influencing on energy prices, I think that we may see that. Now, let's come back to tariffs, and let's talk about tariffs for a moment. So when I first started mentioning that, we talked about the Harley-Davidson example. But now look at what's happening. You've got soybean issues. You've got hog issues. And now that's leaving our farmers basically in a lurch because they can't forward plan on what needs to happen. Do they plant fields? Do they rent machinery, et cetera? That's the contagion there. So it's not just limited to soybeans, but it's all to the other areas, right? The machinery. That's why you're seeing problems. When the Dow got hammered, you saw Caterpillar flying, down that path as well. Now, China is already retaliating, but not necessarily in the dollar-to-dollar format, as they are the ones that have been benefiting in the world trade, so they can't go dollar to dollar. But now what they're going to do is they're going to come back and they're going to hold up our imports going into the U.S., or they're going to delay mergers and acquisitions. So the trade war is not necessarily there. It's still rhetoric, but nobody seems to be budging just yet, right? And that's the problem. So we have to pay very careful attention, because if we do go into a full-blown trade war, which I said I didn't think would happen, well, that's where things can get pretty bad for the market. Now, putting all that aside, the macros look good. GDP numbers were fine, as we know from last quarter. The employment data was actually very strong. macros look good. However, the technicals are not such. However, in addition, the technicals also maintain their support. We bounced off major averages. The Dow Jones is back up near its 50-day moving average. S&P's there, and the Russell and the NASDAQ continue to shine. So we're in for what I think is going to be a good earnings season number-wise. Technically, it's lining up that way, but we really have to pay attention again to reactions. That's really very important. Okay, guys? So if you're trading these moves, remember stock and stock options involves a substantial degree of risk. It's not suitable for all investors. And if you're like me and you like to watch the charts, always remember past performance is not necessarily indicative of future results. I'm Al Ibaroa, Financial Intelligence Training. Thanks for watching, everyone.